Welcome to the deep dive. Today we're getting into the nuts and bolts of the residential construction sector.
It's definitely a hot topic right now.
Yeah, absolutely. We're zeroing in on three of the real heavyweights.
Yeah.
D.R. Horton, Lennar, and PulteGroup. So DHI, LEN, and PHM.
The big three, essentially.
Exactly. Our plan here is to give you a really detailed look, kind of like a journalistic report. We'll hit the basic data, financials, valuation, what the charts are saying, recent news.
And that fun paper money math bit too, right?
Just to illustrate things, we're pulling this all from stock screeners, company info from Fevenday's news reports. Got a good stack of sources here.
And it's comprehensive.
Okay, but before we really jump in, just a standard but important reminder. This is all for information and education, okay? We're looking at public data.
Right.
None of this is financial advice. No recommendations to buy or sell anything. Investing has risks. Always do your own research. Maybe talk to a pro. You know the drill.
Absolutely essential. And what makes this sector so, fascinating right now is all the buzz. We'll talk about potential Fed rate cuts maybe coming soon. September 17th is a date being thrown around. That's huge for housing.
Huge impact on mortgages, construction loans, everything.
Precisely. And then you had Warren Buffett's Berkshire Hathaway making those big investments in D.R. Horton and Lennar announced back in August.
Right. That definitely turned some heads. Seeing Buffett move into homebuilders.
It signals something, doesn't it? Creates a really dynamic picture for these companies.
Okay, so let's start with the biggest one, D.R. Horton, ticker DHI. Largest market cap of the three we're looking at today.
Yep, the leader of the pack by size.
Founded 78, based in Texas, builds homes all over. Looking at the numbers from September 11th, 2025, closed at $181.01. Nice jump that day, up nearly 2.8%.
Decent move.
Puts their market cap at what, almost $54 billion? With just under 300 million shares out there?
Yeah, $53.96 billion. It's a big operation. And their financials. Pretty solid story there.
Tell me about it.
Okay, so income, you're looking at just under $4 billion on sales of about $34.5 billion.
Wow. Healthy numbers.
Right. And the margins look good, too. Profit margin over 11%, gross margin near 25%. Shows they manage their costs well.
And liquidity. That's always key for builders, isn't it?
Crucial. And DHI looks exceptionally strong here. Quick ratio is 1.06. Current ratio is almost 10.
10. That's really high.
It is. It means they have tons of assets, easily convertible to cash to cover short-term debts. Lots of flexibility. And their debt to equity is low, too, just 0.30. Very conservative.
Okay, so financially strong, lots of flexibility, low debt. How's the market valuing them right now? What are the PE ratios telling us?
Right, valuation. The trailing PE is about 14.5. Forward PE is similar, 14.7.
Kind of middle of the road, maybe?
For the sector, yeah. Not super cheap, not wildly expensive.
Right.
Their EPS, earnings per share, for the last 12 months was $12.48. And historically, they've grown earnings really fast, over 27% a year for the past 5 years.
That's impressive growth.
But here's the catch. The forecast for the next 5 years is actually a slight decline, minus 0.40%. And for this year, they expect a drop of nearly 18%.
Whoa. Okay. So great history, strong current finances, but the outlook is dialing back expectations.
Seems that way. It suggests analysts think maybe the peak growth is behind them or costs are catching up. It's a key point to watch.
Especially with all the positive news, like the Buffett investment you mentioned. How do you square that optimism with the potentially slowing earnings picture?
That's the million-dollar question, isn't it? The news definitely fuels short-term optimism. You see the stock jump after earnings beats or when bad jobs data hints at rate cuts.
Right. The market loves potential rate cuts.
Exactly. And Buffett's move adds that long-term credibility. But then you see insiders selling shares. Executives like Buchanan, Odom, Old in August and September.
Insider selling. Could just be planned compensation, though.
It often is, yes. But you note it, especially alongside those softer forward EPS projections. It paints a mixed picture. Near-term hope, maybe some longer-term caution.
Interesting tension there. What about the price chart itself?
Yeah.
How has DHI been moving?
A lot of upward momentum recently. The 52-week range is pretty wide, $110 up to almost $200. That 181 cold close puts it only about 9% off the high, but way up, like 64% from the lows.
Big recovery from the lows.
Definitely. The RSI, Relative Strength Index, is up near 68, getting close to that overbought level, maybe due for a breather.
And the moving averages.
All pointing up. The 20-day, 50-day, 200-day SMAs are all positive, confirming the bullish trend. Its beta is 1.41.
Meaning it's more volatile than the overall market?
Yep, about 41% more volatile, so bigger swings, both up and down, are kind of expected.
Got it. Okay, that's a deep look at D.R. Horton. Let's switch gears to Lennar Corp, ticker LNN, another giant in this space.
Right, often seen as a close peer to DHI.
Founded way back in '54, based in Miami. They do home building, but also financial services, multifamily, bit more diversified maybe.
A little bit, yeah. They have those other segments.
On September 11th, LN closed at $140.09, also up nicely, about 2.6%. Market cap around $36 billion. Fewer shares outstanding than DHI, about 228 million.
Still a major player. Analyst view is similar to DHI, kind of hold on average, target price around $121.
So below the current price then, how do Lennar's financials stack up against DHI?
Solid, but some differences. Income is $3.2 billion on slightly higher sales, actually, $35.4 billion.
Higher sales but lower income than DHI.
Yeah, which means their margins are a bit tighter. Profit margin just over 9%, gross margin around 20.6%, operating margin 11.3%. Still healthy, just not quite as high as DHI.
It's just DHI's maybe a bit more efficient?
Could be. Lennar's returns are good, though. ROA near 9%, ROE 13%, ROIC 12%. Their liquidity is decent, current ratio 3.7, but the quick ratio is lower at 0.62.
Lower than DHI's, you mean?
Yeah, significantly. Still okay, but DHI had more immediate liquidity. Lennar, however, has even less debt. Debt to equity is super low at 0.20.
Wow, very little leverage there. And valuation for LEN.
Lower trailing PE than DHI, around 11.6. Forward PE is similar to DHI's at 14.5. EPS last 12 months was $12.10.
And the future EPS outlook, similar caution.
Even more so, arguably. Next year's EPS growth is projected positive, around 11.5%, but the 5-year outlook is negative 4.5%. And this year, expected EPS is down a whopping 37%.
Oof, down 37% this year. That's a big drop. Any clues in the news about why?
Well, like DHI, they got the Buffett boost in August. There was talk about the stock being up 23% over 3 months recently. The next earnings call is September 19th, so that'll be important.
Anything else?
There was that interesting Fast Company piece in August about Lennar facing unsold completed new build inventory and turning to investors.
Inventory challenges.
Yeah.
That could definitely pressure earnings if they have too many completed homes sitting empty.
Exactly. Managing inventory is key. We also saw a big insider sale back in July from a former 10% owner, LEN FW investor.
Right. So inventory might be a specific headwind for Lennar right now. How's his price action looked?
The 52-week range is 98 rounds to $186. That $140 close leaves it further off its high than DHI, about 25% down, but still up over 42% from the low.
Okay.
Recent quarter was strong, up about 25.6%. Moving averages look positive. RSI is 65, similar to DHI. And the beta, identical at 1.41. Same volatility profile.
Interesting. Okay, third titan, PulteGroup, PHM. Founded in 1950, based in Atlanta. Also does mortgages, title insurance, alongside building homes.
Yeah, another diversified builder.
Closed September 11th at $138.66, up 2.4%. Market cap around $27 billion, so the smallest of the three with just under 200 million shares.
Still substantial, though.
What's really striking here is the analyst view. Recommendation is 1.83. That's much more bullish than for DHI or LN, right?
Yeah.
Closer to a buy.
Definitely the most positive analyst consensus among the three. Lots of upgrades earlier in 2025. Their target price is around $135, just slightly below where it's trading now.
Okay, so analysts seem keen on Pulte. What about their financials? Do they back that up?
Yeah, they really do. Pulte's performance metrics are, frankly, quite impressive. Income $2.7 billion on sales of about $17.7 billion. But look at the margins.
Better than the others.
Significantly. Profit margin 15.5%. Gross margin nearly 28%, operating margin almost 20%. These are the highest margins of the three by a good stretch.
Wow, that suggests really strong operational control.
Exactly. And the returns are stellar too. ROA over 16%, ROE 23%, RIC over 19%. They are very effective at generating profit from their capital.
Okay, highest margins, best returns. What about liquidity and debt?
Liquidity is fine. Quick ratio, 0.45. Current ratio over 5. And debt, lowest of the three. Debt to equity just to 0.18. Super conservative balance sheet.
So financially, Bolt looks like the efficiency leader here. How does that translate to valuation?
It gets the lowest PE ratio. Trailing PE is just 10.4. Forward PE around 12. That often suggests the market might see it as a better value or maybe expect steadier, if not explosive, growth.
Makes sense. And the EPS picture?
EPS last 12 months was $13.38, highest of the three. Historical 5-year growth was also the strongest, over 32%, but
Let me guess. The forward look is weaker.
you got it. Next year's growth is projected quite low, 1.3%. This year expected down 22.6%, and the next 5 years negative 3.3%. So that same pattern holds. Strong history and current stats, but caution baked into the future outlook.
It's fascinating how consistent that pattern is across all three. What's been in the news for Pulte?
They had a good Q2 earnings beat back in July, which boosted the stock. They announced a dividend recently, returning cash to shareholders.
Always nice to see.
There was also that interesting Barron's piece about Pulte's management criticizing Fed Chair Powell on housing policy.
Yeah.
Shows they're engaged.
Taking a stance.
Right. And on a positive note, they highlighted delivering their 100th mortgage-free home to a veteran. Good PR, good cause.
Definitely. Any insider selling like the others?
Yep. Saw sales from a couple of VPs back in August and February. Seems to be a common theme, perhaps just diversification or option exercises.
Okay. And Pulte's chart, price action.
PHM has had a great run. 52-week range, 88 grounds to about $149. That 138 close is only 7% off the high and a strong 57% up from the low.
Even closer to its high than DHI was.
Exactly. And its recent quarterly performance was very strong, up 34%. Here's a key difference. Pulte is the only one of the three with a positive performance over the whole year, up about 5.4%.
Oh, that's significant. DHI and LN were negative year over year.
Right. Based on the data we have, yes. Pulse moving averages are all positive. RSI is 65.7, and its beta is 1.31, the least volatile of the three.
Interesting. Still more volatile than the market, but less so than DHI or LEN.
Correct. Might appeal to investors looking for slightly less turbulence within the sector.
Okay, wow, we've covered a lot of ground on each one. Let's try to synthesize this. Comparing the three, D.R. Horton is the giant, great liquidity, strong recent gains.
But maybe facing some future earnings normalization.
Right. Lennar is solid, very low debt, but maybe tighter margins in that inventory question mark, plus a steeper projected EPS drop this year.
And also got that Buffett nod alongside DHI.
And PulteGroup, the efficiency star, best margins, best returns, lowest PE, lowest debt, most bullish analysts, and the only one positive year over year.
But still facing that same projected longer-term EPS decline like the others.
It seems like the whole sector is riding this wave of rate cut optimism in the short term.
Absolutely. All three being in the S&P 500 underlines their importance. The recent quarterly performance across the board screams Fed pivot hope.
And Buffett placing bets on DHI and LEN just adds fuel to that fire, suggesting he sees value maybe linked to those rate cuts.
It's a powerful signal, though the insider sales across all three offer a little counterbalance, a reminder that executives manage their own holdings too.
And that consistent theme of projected negative EPS growth over 5 years. That's the big caution flag hanging over the celebration, isn't it?
It really is. It suggests that despite the current strength and optimism, the market anticipates headwinds down the road. Maybe a cooling housing market, maybe rising costs, maybe both.
Now, let's quickly revisit that paper money math to see how those quarterly gains played out hypothetically. If you had, say, $10,000 to put in each at the start of the quarter.
Purely for illustration, of course.
Of course. For D.R. Horton, with that 45% gain, your $10K would have hypothetically grown to about $14,480. A nice $4,480 profit on paper.
Strongest short-term pop.
For PulteGroup, the 34% gain turns $10 into roughly $13,311 gain.
Still very solid.
And for Lennar, the 25.6% rise takes the $10 to about $12,468.
Oh.
A paper profit of around $2,468.
Clearly shows DHI had the biggest recent momentum in percentage terms. But it's crucial to remember the scale here.
Waiting.
Even that hypothetical $10 or $14K holding is an absolutely minuscule fraction of these companies. We're talking like 0.00003% or 0.00005% of their total market cap or shares.
Right. Puts into perspective why big institutional moves like Berkshire's actually matter to the stock price. Our hypothetical trades are just drops in the ocean.
Exactly. It underscores the scale of these operations.
So wrapping this all up, what's the key takeaway for someone listening, trying to make sense of this sector? It's really about digging deeper than just the headlines, right?
Absolutely. You need to see the interplay between the financials, the valuation, the news, the technicals, and the broader economic picture, especially interest rates.
And understanding that even within the same sector, these companies have distinct strengths and potential challenges. DHI's scale, Pulte's efficiency, Lennar's diversification, and inventory situation.
Precisely. It's not monolithic, and this analysis really tees up a critical question, I think.
Go on.
In a market so driven by macro factors like interest rates and overall sentiment, how do you balance that backward-looking performance, which has been strong recently, against those more cautious forward-looking projections and analyst views?
Yeah. Past performance versus future expectations.
Mhm.
The classic dilemma.
And the immediate question, what will the Fed actually do on September 17th, and how will these stocks react? It's something to really ponder.
A perfect thought to leave lingering. We encourage you to keep digging and thinking critically. That brings us to the end of this deep dive on D.R. Horton, Lennar, and PulteGroup.
Thanks for tuning in.
Thanks for listening. Join us next time on The Deep Dive.